Welcome to The Explainer. Today, we're pulling back the curtain on the incredibly elite and honestly somewhat secretive world of securities-based lending. We're going to uncover a massive secret about wealth management, specifically how lenders actually evaluate your blue-chip shares when you try to use them as collateral. Now, if you've ever just assumed that holding a famous, globally recognized stock automatically guarantees you the absolute best loan terms, well, you might be in for a bit of a surprise today.
Okay, picture this fascinating scenario for a second. You've got two investors. They present portfolios with the exact same nominal value. They're literally holding the identical, globally recognized stock on approved exchanges. And yet, one of them walks away with highly favorable loan-to-value ratios, while the other gets hit with absolutely terrible loan terms. How on earth is that possible? I mean, if the asset quality is identical, what is the lender actually looking at?
Well, there's a total disconnect happening here. On one hand, you have the borrower's mindset. They're assuming the prestige and that shiny blue-chip label of their asset is a golden ticket that guarantees great terms. But on the other side of the table, you have the lender's cold, hard reality. Lenders, they don't care about prestige. They are looking strictly at execution risk and liquidity. All they want to know is, if things go completely south, how quickly and efficiently can we sell this position?
So having shattered that assumption, here's our roadmap for demystifying the underwriting process today. We're going to hit 1. The blue chip myth. 2. Liquidity and trade volume. 3. Concentration risk and haircuts. 4. Behind lender underwriting. And finally, 5. Structuring the perfect facility.
Let's dive right into Section 1, the blue chip myth.
Here's the harsh truth, straight up. Blue chip is a borrower's label. Lenders do not use it. When lenders see a major global stock, they assume its eligibility as a basic starting point. It's table stakes, not the finish line. The lender isn't actually assessing the quality of the company itself anymore. They are assessing how efficiently they can dump it if you default. And that realization, it completely shifts how high net worth investors need to approach their collateral selection.
Which naturally brings us to Section 2, liquidity and trade volume.
This leads us to the single most important metric that lenders actually care about. It's the holy grail of underwriting, ADTV, or average daily trading volume. This metric determines exactly how large your specific position is relative to the market's overall ability to absorb it. Think of ADTV kind of like pouring water into a river. If you pour a tiny cup of water in, it goes completely unnoticed. But if you try dumping a whole reservoir in all at once, you're going to flood the town. In market terms, you will violently crash the stock price just by trying to sell.
To put that into perspective, let's look at some real numbers. Say you have a £50 million position. If that stock trades £500 million a day, your position is a drop in the bucket. It poses minimal execution risk to the lender. But if you hold that exact same £50 million position in a stock that only trades £20 million a day, you now represent 2.5 days of total market volume. Any quick attempt by the lender to exit is going to absolutely tank the price of the stock. And you better believe lenders price that execution risk directly into the terms they offer you.
All right, Section 3, concentration risk and haircuts. Now that we've got a handle on volume, we have to talk about what happens when you put all your eggs in one very nice basket.
A highly concentrated portfolio, where almost everything is skewed to one single stock, absolutely terrifies lenders, and they assess this concentration risk completely separately from liquidity. Why? Well, if that specific stock plummets right at the exact moment you default, there is zero diversification effect across other sectors or geographies to absorb those losses. The lender's exit risk is entirely tied to one single name.
Because of that fear, lenders directly price this concentration risk into your loan through what's known in the industry as a haircut. Depending on the daily trading volume, the volatility, and just the lender's general appetite, they'll typically discount your concentrated collateral by 20 to 40% of its current market value. This creates massive friction for borrowers who strut in expecting a smooth 75% loan-to-value ratio, only to find out the lender requires a huge and often frustrating safety margin.
Let's peel the onion a bit further in Section 4, behind lender underwriting, and really examine the dense realities that dictate the fine print of your facility.
Behind closed doors, lenders are obsessively scrutinizing 4 primary structural hurdles before they even think about issuing a term sheet: the specific exchange, the margin call architecture, the treatment of corporate actions like your dividends, and insider compliance. Let's quickly break these down.
Here's a crucial takeaway.
Lender appetite is dictated almost entirely by the settlement reliability of the exchange itself. Exchanges like the LSE, Euronext, SGX, or ASX generally see strong lender appetite because their settlement infrastructure is incredibly well-known and efficient. On the flip side, emerging market exchanges are often just flat-out rejected, totally regardless of the stock's massive market cap or its trading volume. And get this, the borrower's actual home country? Completely irrelevant. It is all about the exchange.
Next up is the margin call architecture. If market volatility causes a routine 25 to 30% drop in your stock's value, which, let's be honest, is definitely not unusual in a market correction, you can instantly breach your margin threshold. This is exactly why lenders build in those defensive safety buffers we talked about. If they gave you full loan-to-value right out of the gate, a 25% drop would trigger an immediate crisis. The whole idea that a blue-chip asset guarantees a low-risk, worry-free loan completely falls apart when you factor in real-world market volatility.
And finally, Section 5, structuring the perfect facility. Let's translate all of these lender secrets into some actionable takeaways you can actually use. To win at this game and secure terms that reflect your collateral's true value, you've got to make 3 critical decisions. Step 1, instead of demanding maximum LTV right away, consider tranching your loan, meaning you step up your borrowing over time to drastically reduce your margin call risk. Step 2, clearly define your liability. A non-recourse facility limits the lender's claim strictly to the collateral, while full recourse exposes your other assets. And Step 3, lock down a rock-solid secure custody account.
Actually, I really want to hammer home that last point. Custody is absolutely not just some administrative detail or paperwork. It is the literal foundation of the transaction. Your shares have to sit in a custody account that the lender actually trusts, while still preserving your rights to things like dividends. A weak custody arrangement creates massive execution risk at default. If the lender isn't 100% confident they can access those shares the second they need to, they'll either aggressively price that risk into your terms or just flat out walk away from the deal.
So as we wrap up this explainer, I want to leave you with a question to chew on. Does your loan structure reflect your actual market position? Once you understand that lenders are evaluating liquidity, daily trading volume, and custody, rather than just admiring a prestigious brand name, you can enter these negotiations from a position of real strength. I highly encourage you to rethink your own collateral strategy and look far beyond the blue chip label. Thanks for joining me today, and keep learning.